Hey, and welcome to the stuff you should think about. I'm your host, G. And in today's episode, we're going to be talking about credit default swaps. When people hear the term credit default swap, their eyes often glaze over as if they've stumbled into a secret chamber of financial arcana. But beneath the intimidating vocabulary lies a concept that is surprisingly familiar, a concept rooted in something humans have been doing for thousands of years, managing risk, and to understand how credit default swaps work. We need to zoom out, widen the frame, and look at the financial universe the way an astrophysicist looks at the cosmos. As a system of forces, interactions, and delicate balances, a credit default swap, or CDS, is essentially insurance. Not insurance for your car or your home, but insurance for a loan. Imagine you lend money to someone, a friend, a company, even a government. You hope they'll pay you back, but hope, as any scientist will tell you, is not a strategy. So you buy a CD, you pay a small fee to someone else, and in return, they promise to compensate you if the borrower fails to repay. It's a safety net for lenders, a cosmic shield against the gravitational pull of financial collapse. But here's where it gets interesting. Unlike traditional insurance, you don't have to own the loan to buy a CDS. You can insure a loan you never made. It's like buying fire insurance on your neighbor's house. If it burns down, you get paid. And suddenly the system becomes more complex. Not unlike a galaxy where stars begin interacting in unexpected ways, creating gravitational distortions that ripple across the entire structure. To understand why this matters, let's zoom out again. The global financial system is a network, a web of obligations, expectations, and trust. Every loan is a promise. Every investment is a bet on the future. And every CDS is a way of shifting risk from one part of the system to another. When used responsibly, CDSs stabilize the system. They allow lenders to take calculated risks. They distribute uncertainty across a wider field, much like how dark matter distributes gravitational influence across a galaxy, keeping it from flying apart. But when used irresponsibly, when speculation replaces prudence, CDSs can amplify instability. They can turn a single failing loan into a chain reaction, a supernova of financial consequences. This is what happened in 2008 when institutions bought and sold CDSs on mortgage loans that were far riskier than they appeared. The system became saturated with bets on bets on bets. And when the underlying loans began to fail, the CDS market didn't cushion the impact, it magnified it. The shock waves rippled outward, collapsing institutions that had never touched the original mortgages. It was a reminder, a cosmic reminder, that complexity without understanding is a recipe for disaster. But let's not lose sight of the deeper lesson. A credit default swap is not inherently dangerous, it's a tool. And tools reflect intentions of the people who wield them. A telescope can reveal the secrets of the universe, or it can sit unused in a closet. A CDS can stabilize a financial system, or it can destabilize it. The difference lies in transparency, regulation, and the collective wisdom of the participants. Now, let's take an even broader perspective. Humans have always sought ways to manage uncertainty. Ancient traders used contracts to protect themselves from storms and crop failures. Medieval merchants pooled resources to insure their ships. Modern investors use derivatives like CDSs to navigate the unpredictable tides of global finance. In every era, the goal is the same: to bring order to chaos, to impose structure on the unknown. And that's what makes credit default swaps so fascinating. They're not just financial instruments, they are expressions of human psychology. They reveal our desire for security, our fear of loss, and our belief that the future can be shaped, or at least hedged against, through clever design. So, do credit default swaps make the world safer or more dangerous? The answer, as with many things in the universe, is it depends. It depends on how they're used, who uses them, and whether the system as a whole remains transparent enough for participants to understand the risk they're taking. In a well regulated environment, CDSs can act like shock absorbers, dampening the turbulence of the financial market. In a poorly regulated one, they can act like accelerants, turning sparks into firestorms. In the end, a credit default swap is a reminder that the financial world, like the cosmos, is governed by forces we must understand if we hope to navigate them safely. And just as astronomers map the stars to predict celestial motion, economists and regulators must map the intricate web of financial relationships to ensure stability, because in both realms, the cosmic and the economic, ignorance is not just lack of knowledge, it's vulnerability. Thanks for listening.